Thanks for tuning into today's Talking Point. I'm your host, Neeraj Shah, and the Talking Point today are the views of Amish Shah of BofA Securities. Amish, great having you. Thanks for joining in. Hope all is well.
Absolutely, Neeraj. Good morning and thanks for hosting me.
No, the pleasure is ours. So, Amish, well, I wouldn't say a decent size up move, but a reasonable up move from those lows that we hit sometime in February from 16,800, 900 circa. We are much higher. I remember you were not completely constructive. There has been a small rally to that view. What's your stance currently, and why would that stance be?
Sure. So Neeraj, look, I believe that we are at the fag end of the rally that we've seen over the past few weeks, as you mentioned. We continue to believe that this year Nifty will be in a small band. We are calling the trading band to be 16,000 to 18,000 for Nifty for this year. There could be obviously there could be some more upside from where we are as we head closer to that 18,000. But if you're a short-term investor, I would argue that this is a good time to book profits. Broadly, we believe to the point that you made from the last time that we spoke, that this is going to be a year of consolidation. And as a result, we do think that India will underperform emerging markets as well as fixed income markets this year. So from where we are on Nifty, if you're an incremental investor, you are better off with bonds as compared to equities, purely comparing returns primarily. So I would be more constructive on market if we go to the lower end of my band, which is around 16,000.
Interesting. Amish, so I would urge you to tell us why is that the case? Because the bull argument seems to be that inflation is a conversation of the past, if you will, or at least the interest rate moving up higher is now a thing of the past. Markets look 6 months out, so that problem is out of the way. Valuations relative to the rest of the world, Indian valuations by virtue of earnings growth as well as the other markets doing better in the last few months have also become significantly better than what they used to be. So why is it that you believe that there is a possibility of a substantial downside? By substantial, I mean about a 5 to 10% downside from where we are currently.
It's a fair point, Neeraj. Look, valuations, first of all, I would argue is a function of earnings. My problem to begin with is the earnings expectations. I think expectations are just way too lofty. Let me put this into perspective. For Nifty, the earnings growth that consensus expects, or the earnings particularly that the consensus expects to be delivered in FY24, we think is likely to be delivered in FY25.
Wow. Okay.
Put it differently, if you look at the consensus expectations, consensus is expecting 18% earnings growth for Nifty in FY24 and another 14% growth in FY25. So 2 years cumulative, we are talking about 33% growth. And our numbers suggest that the 2 years cumulative number will be 17% growth. So your consensus growth is we expect will get cut by half. And now as that happens, the valuations that seem to be fine currently will start to look rich. And as you then again start to normalize valuations, I think that will be the consolidation or the correction that we are talking about.
Wow. So where is it, Amish, that you are in such stark contrast to what the consensus would be? What themes or what are the pockets where you believe there will be acute disappointments, if you will?
So, we have been underweight on IT, consumption, and telcos primarily. And I think these are the sectors that will lead large earnings cuts. Obviously, other sectors also will have earnings cuts, but we think the IT consumption, telcos will see outsized cuts. Few reasons for that. So to begin with, we as a house are definitely of the view that US is heading into a recession. So beginning the second half of this year, we are calling for US recession. I think for most others, it is still a debate out there. But if you work with the recessionary scenario, then the earnings that you may want to budget for IT companies or even consumption companies or even some external focused auto companies will be very different from what we are talking at this point in time. So I think global conditions or global macro conditions are going to be worse than what the market seems to be projecting right now. Take for instance, if you look at the forward market in US, it's a consensus now that Fed will hike the last time in May, so that's fine. But the problem is that the forward market in US is also budgeting for rate cuts to start from June this year, and by the December of next year, markets are suggesting 200 basis points of rate cuts. Uh, Contrasted to our views, we are saying that until the March of 2024, Fed will pause but not cut. So that's a pretty big disconnect in terms of then what are you talking about in terms of US growth, the credit conditions in the US, and back home, we all know that the urban consumption is leveling off. Rural revival is still not very visible. There is a risk of crude prices going up. So when one budgets for all of these risks, which we are, we end up with much lower earnings growth in comparison to consensus.
Okay. If that scenario were to play out, and I would just wonder actually that I don't know if you got a chance to look at the TCS commentary and the reportage, but does that leave you with some question marks and strengthen your belief about the near term? Because while TCS said that growth will accelerate once the pressures subside, there is no timeline, obviously, that anybody can give about when the pressures would come, and the SVB issue would probably only exacerbate the pain from the BFSI clients, if you will.
Absolutely, Neeraj. So broadly, if you look at IT companies as an example, just track their commentaries over the last few quarters. It was about no problem at all, translating into some sectors having an issue, translating into some markets having an issue. We've seen BFSI slow down. We've then seen manufacturing having some issues, high tech as a segment, retail. So the number of sectors where the growth is slowing down is only expanding, it's not contracting. And look, I get it. This is an evolving situation. If you were back in December last year, what were the views? The consensus view in December last year was that US will head into a recession in the first half and will recover in the second half. But as we all know, that the recessionary talk has only got delayed or pushed out. So as a result, the pain that one was expecting at the start of the year is more likely to be in the second half of the year. So we have only delayed the issue, but we don't think that we are out of the issue, unfortunately.
Got it. Where I want to play the devil's advocate is on consumption in India. Amish, skeptics of a theory that you are proposing would argue that urban consumption is leveling off, but it's not falling off the cliff. If anything, it's returning to long-term averages. And in rural consumption, given the fact that it's a pre-election year and infra now constitutes such a large portion of the rural household, the government spend on infra, which has been budgeted for, so to say, would ensure that rural consumption will come back. Most economists are actually penciling that, saving for inflationary pressures in milk, crude, and some of the other factors. How would you therefore contrast that hypothesis?
So I would agree with most of that, but my problem still then is expectations versus reality. So has rural bottomed? Yes, we agree that the rural has bottomed, but the growth that you see in some of the rural focused stocks and sectors, is that growth likely to be materialized? The answer to that, unfortunately, is no. So I agree that the urban consumption is holding quite well, but if you look at most discretionary companies, the earnings growth expectations is around 25, sometimes in some cases even 30%. We are of the view that it is more likely to be about 15%. 15%, you can argue that is not a bad growth in the environment that we are in, but it still means a downside for stocks.
Okay. Now, so let me try and now flip the question on its head, Amish. You spoke of a band of 16,000 to 18,000. We are circa 18,000 currently. I mean, give or take a couple of 100 points. So my question is, in a scenario when rates are, maybe they get cut only in next year's March, as you said, if I'm not wrong, But if the conversation moves from how much would the rates go up to the question of when they get cut, and who knows, March may get preponed as well, right? I mean, it's an evolving situation, as you said. So my question is, how would such a scenario, or why would in such a landscape, equities would correct to the tune of maybe 7 to 10%? What would lead to that such a sharp corrective move in equities globally and equities in India?
So it's a very good question, Neeraj. I will go back to saying that earnings is obviously something that we will have to work with. But more importantly, we had done some analysis around the question that you asked, and what we realized is that first of all, market bottoms during a recession, not before a recession. So we have not even started a recession, and then therefore we need and the reason for that is quite simple, that once the bad news is out there, markets will bottom. Currently, you are only debating how worse it could be. We don't know that yet. So that's the first thing that I would say. The other thing I would say is that if you do a combination of credit tightening and liquidity tightening, or credit easing and liquidity easing, so you can draw four scenarios on the back of credit and liquidity where where it's heading. The scenario that you are highlighting is more of credit tightening but liquidity easing. And like it or not, that unfortunately is the worst phase for the markets. Historically, whenever you compare the combination of easy liquidity with tighter credit, markets unfortunately give you the worst returns, which is the period that we are getting into.
Wow. Okay. So Amish, what's the base case if indeed all of the things that we are fearing, let's say, do turn out, which is that crude prices, by virtue of what OPEC and Russia have done, actually inch higher, and therefore you're in a bit of a mix when it comes to what happens to inflation. If earnings cuts in India indeed turn out to be the way that you are talking about as well, and that the West is in a recession, and therefore the export demand comes under even a bigger question mark, um, what would help the markets be in this band and not overshoot the band on the downside?
Sure. So I do think that beyond 16,000, markets will be protected as well, and there are two or three factors that help us come to that view. So the first is, if you look at the FII positioning, in terms of their overweight positioning on India, as well as their ownership, both is at a multi-year low. Just to put some numbers to it, FII is at the peak, and the peak used to be in December of 2019. Used to own 23% of Indian equities. Currently, they own 18.5. So that's a sharp. They've sold a lot of equities in short. Their overweight positioning on India is currently only at 24 basis points. And basis our conversations with the FII investors, I can tell you that most FII investors can take India to a neutral weight, but they cannot take India to an underweight, primarily because Indian macro is doing much better, even in this current environment, in comparison to other emerging markets or even developed markets. So you can go to a neutral weight, but not a large underweight. And if you are going to go to only a neutral weight, then 24 basis points is very little that you can sell incrementally. So as a result, we think that while there may be FII outflows, the pace of FII outflows will now definitely slow down. So that's the first reason. The second is, on the other side, we think that the passive inflows into domestic mutual funds, not just from SIPs, but also from the endowment funds like provident fund, pension funds, etc., will be very strong. We are estimating that it will be about $20 billion in this calendar, and 75% of this $20 billion ends up into Sensex and Nifty ETFs. And as a result, the large cap indices like Nifty and Sensex, the passive money will put a floor at broadly long-term averages, which is around 16,000 of Nifty on our earnings expectations. Mm-hmm. And then lastly, I would say that if the worry is just about US recession right now, then we've also done analysis around what happens to Indian macro and Indian markets when US goes into a recession. And the good news is that Indian economy contracts for a very little period of time, and it rebounds very fast in comparison to the US. And as a result, historically, once the US recession ends, Indian markets have always delivered much better returns than the S&P. So Nifty outperforms S&P in short because the economy rebounds faster in India. So when you take these three things into context, I do think that large cap stocks, especially driven by Nifty or Sensex, would find support at long-term valuations.
Very interesting. Amish, if indeed the earnings cuts are not as sharp as you are penciling in, and if indeed we have this money support which lands a floor, right, to the markets by and large, could it well happen that the band actually gets narrowed if the earnings cuts are not as sharp? Again, part two of my question rolled into this is, you will not get a definitive answer of how much the earnings expectations are changing by virtue of what happens in Q4. It will also be a factor of what happens in Q1, Q2. So for you as an analyst, when do you change your view from what you have currently on the earnings cuts to a slightly better one? I mean, would it take a couple of quarters of next year for you to figure out maybe that the earnings cut may not be as sharp as you are penciling in, but a bit more moderate?
Absolutely, Neeraj. So our worries right now are more, from the global macro, as I've been arguing right now. So if the global macro indeed does not turn out to be as worse as we are expecting right now, okay, clearly that's a positive risk to our estimates. As I said earlier, that currently we are assuming that US gets into a recession from the third quarter of this calendar, so beginning July, and then we will see if things are not as bad as we anticipate, and that could potentially mean an upside to what we are estimating at this point in time.
Okay, so earnings are not the driving factor; it's the macro. The earnings come in later for you.
Absolutely, so it's a worsening macro that leads to earnings cuts, and that leads to the market correction. Obviously, we will have to have a strong look at macro to begin with.
And I know it's difficult to timeline this, but what I'm trying to understand is, Amish, therefore, if indeed your playbook or your analysis turns out to be the playbook, then we are not looking at any material upsides on Indian markets, Nifty, I'm using as an example, for the next 12 months at the very least.
I would argue so. Even at the top end of our range of 16 to 18,000 that I'm talking about, let's assume that the markets are at 18,000. We started the year with Nifty at 18,100, which essentially means that markets are likely to give you flat returns, at best modest positive returns. As I argued earlier, that those kind of returns you could have safely made with debt instruments. Then why take the risk of equities?
Sure, makes sense. Okay. Well, as somebody coined the term, we moved from Tina to Tara. There were no alternatives. Now there are reasonable alternatives, at least at the start of the year, and probably more so. Amish, I'll ask a couple of questions. So in such a equity landscape, you're still obviously telling your clients or advising your clients for their model portfolios to be overweight in select pockets which might do well despite overall earnings growth not looking great. What are those?
So, first of all, we prefer large caps over mid caps. Because there will be a flight to quality, but also, as I argued, that the 75% of that 20 billion passive flow that I spoke about ends up into large caps. So you have more flows supporting the large cap companies as opposed to small and mid caps. Specific to sectors, we prefer financials over IT. We prefer investments or capex related themes over consumption. We prefer power utilities over telecom, and we prefer materials, which is steel and cement, primarily over energy. So those have been our model portfolio for a while now, and we continue to have that skew.
Okay. May I probe a couple of these before we wrap up? So oil and energy is a lesser preferred one over, let's say, metals. Is that going to be the outlook even if oil prices were to harden significantly from where they are right now? And if indeed the recessionary pressures are more severe, wouldn't it be a big dampener for metal demand?
Not so much in India. Large part of the metal demand right now is actually coming from the infrastructure capex, which we all know is quite strong. And look at for the organized steel companies, they're already operating at 85% utilization. Even if you were to start a new steel capacity addition today, it will take you at least 3 to 4 years before it comes up. And as a result, the pricing power for these steel companies is going to be quite strong as far as India is concerned. So demand of the volume growth is strong. Prices hold up. In fact, chances are that they may do a little bit better from here. On the other hand, in fact, your input costs like coking coal, iron ore, etc., may in fact level off, and that may provide you good profit visibility.
Okay. I mean, capex over consumption is justified. Amish, before I take too much more of your time, I will. The last question on the interview, I'm throwing this out of the dark at you, but I know that you guys write a lot of very interesting thematic notes periodically. I don't know when was the last time that you wrote one, but if you remember any one of the recent thematic notes that you may have written and a key takeaway out of that, if you can share that before we wrap up.
There are a few, Neeraj, but let me talk about a few that are top of my mind. So I think exports in India, or current account deficit, more particularly in India, is going to be a big theme. So we are arguing that even if India succeeds only in a couple of sectors as far as exports is concerned, and that is consumer electronics and specialty chemicals, where the visibility of success is reasonably high. So even if two sectors succeed in terms of exports, and on the other hand, if we continue to work around curtailing imports, and we can curtail imports on a variety of things, again with high visibility about defense, around coal, coal imports, and so on and so forth. We are arguing that over a 5-year period, India has a potential of curtailing its current account deficit by 75%. That I think will give a lot of macro stability as far as rates, currency over time is concerned, and that obviously why would imports come off and why would exports grow is a discussion in itself. But I think there's a fair possibility that we can get there. Over and above that, as we all know, that India is very rapidly formalizing, digitizing, decarbonizing. Each one of these are individual themes in itself. But if I were to put a common link to all of this will require capex in order to achieve. Like, let's say decarbonization will require its own set of capex to get there. Formalization of economy will mean more capex from the organized sectors, in order to gain market share from the unorganized. So if I were to sum up big picture right now, we think that India, from a 5-year perspective, is getting into a phase where you can have a confluence of credit growth cycle, capex upcycle, real estate upcycle, and a startup upcycle. And generally, when you have all of these four combined together, it's a very robust macro outlook, and logically, therefore, positive for markets as well. These are long-term themes we think will play out over 5 years gradually. For now, we are more cautious markets, but our outlook on Indian economy is structurally quite bullish.
Amish, such a pleasure talking to you. Thank you for all those insights. Lovely having you today, and look forward to have you more often on the platform.
Absolutely. My pleasure. Thanks again, Neeraj.
And viewers, thanks for tuning into this edition of The Talking Point.